So in this piece, I want to talk about, of course, the interest rates. What's the market doing right now? As you know, we're at 5.25%. We've had 14 consecutive rate rises up to September 23. And finally, there's been a pause. The Bank of England did not continue and ratchet up for the 15th time. They kept it at 5.25. Now, I did say last month that it was on a knife edge. I was really struggling to call whether they would leave it and pause or up it 0.25%. Now, I've had a look at the minutes of the meeting. Yeah, I know. And it was a really close call. It was 5 votes against 4 to leave it where it is. So a really close call. Now, it does feel like the major matrices, the matrix, the data sets as an economy as a whole are going in the right direction. And therefore, my view is that the Bank of England are likely to keep it on pause now. And in fact, dare I say it, I think we might have reached the ceiling. Still a bit early. Look, they've only paused it for 1 month, but as the months continue, I think at the next meeting, which is beginning of November, if they pause it again, I'm be starting to think that perhaps now the Bank of England feel that the ratcheting up of the Bank of England rate has finally done its job and inflation is heading down towards that 2% target. By the way, if that continues, my view is that the Bank of England will not only not put rates up any more than they are now, but in about 18 months to 2 years, they'll even start to bring the Bank of England rate down. Can't say how much. That's, that is a real crystal ball gazing thing, but that's my view. Now, let's move on to mortgage rates. As it says on the bullet point here, they're reducing. They've been reducing now, I'd say about 10 or 12 weeks. And the reason I did allude to this last month, and I'm sticking with my same view, I don't think there's anything more complicated than the banks, the lenders now feel confident enough that they're open for business again. So they're now chasing your business. So they're starting to cut margins. The competition part of this market is starting to come back in and they want a bit more of your business. So they want to get up the league tables a little bit more to, as I say, get a bigger slice of the pie. So what I did this morning, and by this morning, we are on the 11th of October at the time of recording this. I took a snapshot of what the headline rates are. So before I show you them, I do not want any of you guys out there thinking this is advice. You know it's not advice. This is purely the headline rates. You know there's a lot of detail behind and under the surface, and indeed whether those mortgages are right for you. So you know I've got to say that. But there's some real interesting observations I want to share with you today. As you can see, we've got 2 columns. I've got 75% loan to value, and I've also got 60% loan to value lending. And then down the left-hand side, I've split that in 2 parts. One between buy to let, and by that I mean long-term family lets, the AST rentals. And I've also put holiday lets on there because I know a lot of our watchers are focusing on that strategy. And then I've also split it between 2 and 5 year fixed deals. So let's just look at the buy to lets to start with. First thing that really jumped out at me today was that across all of these 4 headline rates, they all start with a 4. Now, since I really didn't think I'd have to say this name again, but since Liz Truss back in September 2022, remember that name? Sent the world to hell in a handcart, then we've not seen rates across the board. There's been some gimmicky ones, but across the board, starting with a 4. They got up to what, 6 and 7% for the buy to lets. So for me, that's really sort of heartwarming. It's really encouraging to see those headline rates under 5%. The second, and I think this is even more important observation, the 2 year fixed rate pricing is lower than the 5-year fixed rate pricing. And if you guys have been listening to me in the past, I've mentioned it a few times that in my 25 plus years of working in this industry, it's only really in the last year that I've seen a reversal of the norm whereby the 5-year fixed rates are cheaper than the 2-year fixed rates. And that was simply because of the impact of Liz Truss and her Chancellor's budget at that point created so much uncertainty, so many ripples on this pond that the financial institutions could not, with any certainty, price their mortgages up. And therefore, in the short term, the 2-year deals got priced more expensive than the 5 years. That's what was going on. But now see what's happening. The 2-year deals have been priced cheaper than the 5 years. In other words, we feel like we've turned a corner. The markets, the institutions, the economists, these guys that are paid a lot of money to try and figure out and predict what's happening in the financial markets and ultimately take that data to put into correctly pricing the rates are now going, yeah, with normal service is resuming. And therefore the 2-year deals are now cheaper. So listen, that's not only good to get that the right way around. What that means is that the lenders out there, they're open for business again. So therefore, yes, they're going to continue to cut their margins. They're going to be widening their portfolio of products to get your business in. More innovation is going to come back into the market. We're going to see perhaps loosening of policy. It's the ripple effect, the knock-on effect to you as landlords who are still active in the market growing your portfolio. We'll start to see this. And that's why I'm getting excited about seeing 2-year deals cheaper than 5-year deals. That's why it's fantastic news. Now, I've also put on there holiday lets. The point on there is that generally speaking, you can see with the headline rate that rates are about 1% more. Lenders have always put holiday lets in with HMOs, in with serviced accommodation, in with multi-unit freehold blocks, seen as a bit specialist, and then perhaps it's a bit of an excuse to charge a little bit more. So that 1% differential doesn't surprise me, fairly typical, but under 6%. And remember, these are starting rates. They're going up from there. And if you're a landlord that's strategy is multi-generational holiday lets, in other words, the larger holiday lets, these are still a bit more commercial and you're unlikely to see rates starting with a 5 for these larger holiday lets. If you're looking for a 1, 2, 3, 4 bed holiday let, then perhaps rates starting with a 5. You may well see. Look, if any of that is any interest to you, if you want to then chat about your circumstances a little bit more, at the end of this, there will be a link to our online diary. You might want to take a screenshot, retype the address into your search bar, into the web address, and that'll take you to our online diary. Free, no obligation chat. Have a chat with the team and let's see if we can help you.